Let's look closely at the source stack in front of us today. We have this mountain of financial press and tech blogs all screaming the exact same headline about Jensen Huang announcing $1 trillion in Nvidia orders.
Well, it is a massive milestone. The market is entirely justified in its celebration here. I mean, $1 trillion in orders is a definitive metric.
Our mission on this deep dive is to put that specific trillion-dollar assumption under a microscope. Let me ask you, listening to this right now, have you actually verified the structural integrity of this narrative, or are you just taking a victory lap on unverified premises?
Look, it signals secured financial pipelines and undeniable momentum from the biggest enterprise clients on Earth. The institutional demand is very real.
Locked in by what mechanism exactly? What is the actual delivery cycle on $1 trillion of hardware?
The delivery cycle won't be an issue because these tech giants desperately require the hardware to build their networks.
More importantly, what are the default costs if a macroeconomic shock hits? Historically, massive enterprise hardware orders get delayed or renegotiated all the time.
The specific contractual penalties are proprietary naturally, but focusing on cancellations completely ignores the reality of the infrastructure arms race.
Did Jensen provide the exact penalty clauses for cancellations during this announcement?
Well, no, but they literally cannot afford to back out. The demand for compute is only going in one direction.
So the entire valuation rests on the assumption that AI training demand requires endless linear hardware growth.
Yes, because the sheer scale of global AI deployment will vastly outpace any localized efficiency gains. The overall demand is simply too massive.
Let's examine the research notes on DeepSeek from our stack. They recently trained a flagship AI model using a fraction of the standard compute power.
Algorithmic efficiency improves, sure, but you have to look at the total addressable market.
If algorithmic efficiency is doubling, meaning models need significantly fewer chips to learn, are clients actually buying compute, or are they buying into a compute inflation bubble?
The global demand is not going to shrink just because one model got optimized. The scale overrules efficiency.
But is that demand truly immune when the basic math changes? Training an AI is computationally heavy, but what about inference?
Inference is just the next phase of the deployment cycle for these clients.
When the AI actually starts answering user questions in the real world, the hardware requirements completely shift. Where's the absolute guarantee that Nvidia captures that inference market?
The guarantee is CUDA. Nvidia's software ecosystem is an unbreakable moat.
An unbreakable moat based on what evidence?
Think of CUA as the foundational language of AI development. I mean, developers have spent over a decade writing complex code specifically for it.
Let's look at the hardware alternatives in our research. Meta just announced 4 new custom inference chips.
Even if alternative hardware exists, rewriting years of code creates a massive friction cost. The ecosystem keeps them anchored.
Anchored or temporarily hostage. Google is actively wrenching out its own TPUs to external clients. Microsoft is accelerating its Athena custom chip project.
Friction always dictates enterprise behavior, though. Saving on hardware expenditures is irrelevant if your engineering teams have to burn billions in time.
If a tech giant saves 50% on their capital expenditures by routing traffic through their own silicon instead of paying Nvidia's premium markup, does that developer friction actually stop them?
The institutional capital backing these orders represents a massive sunk cost into the NVIDIA ecosystem. They would have to translate all their work off the CDA platform.
But what if that translation layer gets automated? Developers might speak CDDA today, but if hyperscalers are saving tens of billions by running daily AI workloads on cheaper chips, is the money actually trapped or just a legacy code?
The broader market is pricing in that structural software advantage for a very good reason, regardless of what custom silicon enters the fray. The ecosystem itself is the product protecting the company's inherent value.
Before we take that assumption any further, I need to deliver a quick reminder to everyone listening. This deep dive into business logic does not constitute investment advice. Markets have risks, so please do your own independent research before making any decisions.
Which is fair, but you cannot ignore the fundamental reality of $1 trillion pipeline as an indicator of inherent value.
So stop being brainwashed by the unstoppable trillion-dollar order cliches. If that CUDA mode gets bypassed by automated translation layers and custom chips handle the real-world workload, is NVIDIA suddenly just another obsolete hardware maker in a race to the bottom? Think I'm too pessimistic? Tell me in the comments exactly how they survived this.